Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and there's a lot happening in the world, of course, but we are seeing volatility start to come down a few notches and just generally things become a little calmer. Except, of course, over in Europe where demonstrations continue to rage on, and in the French situation, it's not a revolution yet, but it's certainly something getting close in that direction as we're seeing hundreds and perhaps thousands of police officers now giving up and basically joining the protesters, and firefighters too. So there's a lot of problems still to unfold over there in France. We've seen massive demonstrations in the UK, Germany, Brussels, Netherlands, and the list goes on. So a little bit of greater uncertainty around the consumer confidence situation in Europe than perhaps the recent data was suggesting. In Australia, meanwhile, we've had consumer price index data out, and inflation in Australia, nice to see, has dropped down to 6.8%. But wait, that's not nice to see. 6.8% is an unheard of astronomical level of inflation. So will the RBA be cutting rates or not? There were some obvious benefits in things like fuel, but overall still broad, strong price gains, just not as strident as they were previously on the previous release, but still very concerning. The Reserve Bank probably should not be raising interest rates any further. My forecast for very hawkish interest rate increases have been based on what I thought the RBA would do rather than what the RBA should do. I do think that the RBA, it likes to win the popularity stakes. In fact, it's probably more important to the governor that he's liked than it is that he does the job well, despite what he says. And that's why he kept interest rates near those crisis levels for so long, because he was very popular when he was fueling a housing property market bubble. So he enjoyed that and kept rates way too low for far too long, and it was obvious to many of us that that was the case. It was obvious to people at home and on the street that interest rates shouldn't have been where they were at the time, but the RBA couldn't recognize it. So after that crisis era, the RBA has made a further crisis error of raising rates too late, too aggressively, adding to the pain of existing high inflation. I think it's time the RBA began to recognize that this extreme inflation itself is a retardation on demand, and that perhaps Australia's biggest risk now is that it is headed for recession. And a lot of people will say it doesn't feel like that, but then they're probably people who have more fortunate lives than most Australians. Most Australians are really feeling the hardship at the moment of these higher prices. Woolworths and Coles have reported changes in shopping patterns to cheaper no-name products and that sort of thing, and lower qualities of foods, which is not good for the nation. So there's obviously a lot of pain out there. We know that rents in some suburbs are up over 30%, and that continues to be a major burden to many hardworking Australians and Australian families. In that light, the RBA probably should not be raising interest rates. It doesn't matter what it does to the property market. If you're in the property market, you're speculating in a market, in a financial asset. So, to say the RBA has to adjust interest rates to support property investors is a nonsense. Property investors, if they want to have returns, have to take risks, and they have to be big people about it if it goes the wrong way. But I do think there's a strong argument for the broad working class, middle class of Australia for interest rates to stop going up. Whether the RBA will do that or not remains to be seen, but there was a great preamble that the RBA could be on pause at this meeting when Kent spoke recently, and I do think that today's inflation number does help that argument significantly. I mean, the worst case scenario is another 25-point rate hike from the RBA, and they say they're going to slow down because they always use the global excuse for anything that they do. They'll slow down at the next meeting because of the global uncertainties, which are significant, and because they see that there is downside risk to the economy. But probably they don't want to talk about that too much either, because that's because of them. So I guess what I'm finding of sort of way through the forest here toward, I do think the RBA could be on hold at the next meeting. If it does hike, it'll hike that once and then it will pause at the following meeting. Most definitely if inflation continues to moderate to the downside. Inflation is not resolved. Inflation is an ongoing problem that continues to hurt Australian families and businesses. But raising interest rates at this point any further does not affect inflation as much as it adds further harm to an already stressed population, further entrenching that trend toward recession, which is why I think the RBA should be on hold at the next meeting. What this means for markets is that the Australian dollar has been sold off a little bit, equities have gone up a little bit, and that's a reasonably rational response. I think the equity market can be trounced at any point, the Australian equity market trounced at any point by what happens in overseas markets, which are being lifted on the day by Alibaba breaking itself up into 6 smaller companies and the value being seen there in buying Alibaba. So that will affect other tech stocks in China tech stocks to some degree as well. Perhaps not as much as what people are hoping, but to some degree. So Australian equities has enjoyed all of that and had a little bit of a lift. The outlook for European equities, I'm not sure is as strong as the market thinks. I believe the US equity market could have sort of just continue to sort of consolidate at current levels for an extended period. And I think the Australian market probably has a little bit more upside, but it doesn't have a lot of fuel left in the tank to keep going in a substantial way. The Australian dollar, bearish the Australian dollar, and still am. It's been a while. And I think it is vulnerable to further downside. The caveat there is that the US dollar also is a highly problematic currency at the moment, because it's not a conspiracy theory to say that the world is shifting away from the US dollar at enormous speed. Even countries like Kenya, the president came out and said to his people, be careful not to be caught holding large numbers of US dollar notes, denominated notes, because things are changing. So the movement towards the euro and the yuan as alternative reserve currencies is, I was maybe the first person in the world to talk about that at APEC in 2012 in a very profound way, and we're certainly seeing that now. I had a meeting with a Deputy Secretary of Trade from China, and I asked him, and this is many years ago, I said to him, so do you think, because at that time I was seeing a prospect for an Asian regional currency akin to the European regional currency. And I put that question to him, do you think there's a prospect of that happening? And he pondered for a moment, and then he said to me, and this was a recorded interview, news interview, and then he said to me, there already is an Asian reserve currency. It's called the yuan. So there you have it. That was many years ago from a senior Chinese official directly in conversation with myself. And I think the movement now where the world's second largest economy has a yuan relationship with Russia, the world's largest energy exporter, that we have the growth of BRICS, which is becoming a stronger and stronger union militarily as well as economically and diplomatically, that we are most definitely headed in the direction of the Chinese yuan being an equal reserve currency to the US dollar. It won't happen overnight, but it's going to be happening very quickly. And I see that as the only reason to be buying Australian dollars. If you think the US dollar could have a significant repricing lower. While the US dollar remains firm, I'm a seller of the Australian dollar, but that's always in the back of my mind. When does that actually begin to happen? That the US dollar reprices 5, 10, 15% lower against all the world's currencies. It will be a multi-year event, not an on-the-day event. So don't get too excited, and it will be a very volatile process and could be hard to trade, but then again, it might be one of the next huge big opportunities in markets globally that we will see. So keep an eye on that. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.